That 4% difference is an astronomical difference, and that's basically what makes or breaks a deal. And we always talk about this on the podcast, right? Like controlling your revenue and maximizing your revenue through maximizing renewal, minimizing timeline to turn and lease, and obviously, maximizing the rents that you're achieving is 80% to 85% of successful asset management because your expenses are fixed in multifamily, broadly speaking, and incremental growth in revenue drops straight to your NOI line, which therefore drives your cash on cash returns and your asset value. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to discuss a couple of key calculations as it relates to understanding how to underwrite vacancy for a particular deal or in your market, or as it relates to your strength as an operator or a management company or an asset manager, etc. And the reason that I wanted to record this video is I don't think many investors have actually taken the time to understand, what drives a vacancy rate assumption. I would venture to guess that the vast majority of listeners and multifamily investors in general just have they just have their standard vacancy assumption that they use when underwriting deals. They use their 4% number, their 5% number, their 6% number, whatever it is. And that's just their vacancy rate assumption. And that's just what they use when they underwrite. But many investors haven't actually spent the time to think about like what that actually means in the context of, what is my typical renewal rate? How long does it take me to turn over a unit and release it and sign a new lease with a new tenant? Specifically, what is that lease start date? And downstream, what does that actually translate to in annual vacancy? So what I'm going to share here is a few different calculations that you should be able to just quickly refer to or understand as it relates to what should be the right vacancy assumption in your business. Now, this is going to be a bit of a dense conversation from a data numerical standpoint. If you're driving in the car, you can certainly listen to this and understand the implicit takeaway, which is a couple of key stats. I guess compare them to your business and how you operate, and you'll walk away with something here. If your eyes start to glaze over just based on the dense nature of this conversation, I'm going to pause and try to call out different scenarios in which, listeners should perk up, because I think there's going to be a couple of numbers that I share here that are going to be relevant for most listeners. But my goal here is to get you thinking about what your vacancy rate assumption actually means when you're underwriting a deal outside of just using the number that you feel like everybody uses. So number one, we're going to compare a couple of different scenarios as it relates to renewal rates and using a static or fixed time to renovate, list, and sign a lease for an apartment. Now, all of these calculations are done just assuming a 10-unit building just for ease of analysis. Obviously, with smaller buildings, when you have a unit that goes vacant, it's a higher percentage, or I should say a smaller building. It's going to be a higher percentage of the property itself. Over a longer hold period, you would assume that this stuff starts to normalize. But again, this data, while it may look like a little bit of a different figure on a smaller building, over time, from a hold period standpoint, everything should start to quote unquote normalize, right? But we're just going to assume that we own a 10-unit building for the sake of these calculations. So let's assume that you have a good renewal rate for your units, right? You do a good job with your maintenance. You're very communicative. You're very proactive with signing lease renewals. And you've created an experience where folks want to renew. And you place your tenants in such a way that you're accepting tenants who are likely to want to renew. Or you're just dealing with a building that has units that are typically renewed more frequently, right? Which is the larger bedroom count units on average versus smaller, one bed or studio units that have a lower renewal rate on average. So let's say you have a good renewal rate of 60%. We're going to assume that 50% is kind of average here. So you've got an above average good renewal rate of 60%. And on average, it takes you 4 weeks to renovate or turn over, list an apartment, and then sign a lease, right? If somebody moves out on the 1st of March, it's going to take you to, the 1st of April to have another lease start date with a new tenant. And again, that's just the assumption we make. And we're going to later discuss maybe what happens if you can turn and lease units faster, slower, etc. But let's say 60% renewal rate, 4 weeks to renovate, list, and sign a lease on an annual basis. That means your occupancy is 96.9%, and we're just going to say 97. So that means on an annual basis, you've got about 3% vacancy, which is a good figure, right? That means you're doing a good job. Now, let's say you have a 50% renewal rate, same thing, takes you the 4 weeks on average to sign, renovate, list, and sign a lease. Your occupancy is then 96.1, let's call it 96. Your vacancy rate's 4%. Let's say you have a below average poor renewal rate of 40%. It takes you 4 weeks to renovate, list, and sign a lease. That means your occupancy is 95.3, and we'll just round it down to 95. So the difference between 3, 4, and 5% vacancy rate as it relates to renewal, your renewal rate, assuming 4 weeks to just once a tenant moves out before you have a tenant moving in, is 60%, 50%, and 40% is your renewal rate. So a nice little kind of back of the napkin way to understand what the right vacancy rate assumption is. I think if you're just average across the board and you have a 50% renewal rate and it takes you about a month to release an apartment after somebody moves out, you're going to have about 4% vacancy on an annual basis. Then you add in your 1% in economic delinquency, and maybe you're at your 5%, right? And that's kind of how you arrive at that underlying assumption. But if you're really good at renewing units or you're buying properties that have a higher renewal rate because of the units that are there, maybe your vacancy rate's a little bit lower. And then if you're on the other end where you got a bunch of studios and one beds, maybe your renewal rate's going to be lower and your vacancy is therefore going to be a little bit higher. Now let's talk about, with a fixed renewal rate of 50%, but different timelines to actually renovate, I should say turnover slash renovate, list an apartment for rent, and have a lease signed with a new tenant. So let's say, what I'll define as good is 3 weeks instead of 4 weeks, which is then, we'll translate that to if you have a 50% renewal rate and it takes you 3 weeks to renovate, list, and sign a lease, your occupancy is then 97.11. We'll just round that to the 97% figure. Same scenario as above. If you're 50% renewal rate, 4 weeks to renovate list, you're at that 96%. And if it takes you a little bit longer to do this, let's say you have a 50% renewal rate, but it takes you 5 weeks to renovate list and sign a lease. Well, now your occupancy is 95.2 and we'll round that to 95. So again, the same three scenarios, right? If we're solving for 3%, 4%, or 5% vacancy, the good scenario is you're turning in 3 weeks. Middle is 4, longer term is 5, right? And that assumes a renewal rate of that 50% figure. So again, it helps you understand what your average vacancy is with an average renewal rate, but different timelines to renovating and leasing apartments. Now let's talk about what is the best case scenario, the worst case scenario. And obviously the best can be better and the worst can be worse, but I'm just using that terminology here to illustrate slightly more extreme scenarios in either direction. Let's say you have a 60% renewal rate and it only takes you 3 weeks to turn a unit and sign a lease. That means your occupancy is 97.7. So you're getting up there pretty close to 98. And we'll just round it up to 98 for purposes of this conversation, just to make the numbers simple. That downstream leads to 2% physical vacancy, right? If you're renewing at a higher rate of that 60% and you're turning at a rapid speed of 3 weeks, now you're basically at 98% occupancy, which is a really, really healthy number. Now let's say you're renewing at a lower rate and of 40%, and you're turning at a longer than average timeline of 5 weeks. Now your occupancy is 94.2, and we'll round that down to 94. So that means you're at 6% vacancy. So the difference between 2% and 6% is a 60% renewal rate and 3 weeks to turn units at the 2%. And at 6%, it's 40% renewal and 5 weeks to turn. And that 4% difference is an astronomical difference. And that's basically what makes or breaks a deal. And we always talk about this on the podcast, right? Controlling your revenue and maximizing your revenue through maximizing renewal, minimizing timeline to turn and lease, and obviously, maximizing the rents that you're achieving is 80% to 85% of successful asset management, because your expenses are fixed in multifamily, broadly speaking, and incremental growth in revenue drops straight to your NOI line, which therefore drives your cash on cash returns and your asset value. So if you can renew 60% of your units, and the ones that you don't renew, you can turn and lease in 3 weeks, you're going to be operating at a really, really high level. And let's just say you can't do a great job, or your PM's not doing a great job, and you're at 40% and it takes you 5 weeks. That's going to be tough, right? You're going to have to underwrite a higher vacancy rate. So broadly speaking, the base case to bring this all the way around, most multifamily investors are typically using a number of 5% as their vacancy rate, very quick back of the napkin, underlying assumption in many markets. The base case for this is roughly a 50% renewal rate. And on the folks that don't renew, it's taking you 4 weeks to turn and lease to a new tenant. And that's the 96% physical vacancy. And then you've got a little delinquency assumed, call it one, maybe a couple percent, and that gets you to your 5-6% overall, loss of revenue between your gross potential income and your actual gross collected income. So I thought this was an interesting little scenario to kind of dive into, or scenarios to dive into, to illustrate the difference in what you actually have to do operationally to achieve different vacancy rates. And if you found this episode helpful, tactical, insightful, which I hope you did, this is a quick one, please leave the podcast a rating and review, as it helps the show get noticed by more folks. And again, thank you all for listening, and I'll catch you guys on the next episode.